This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now in our studios in Hong Kong is David Chu, Bloomberg China economist. David, we mentioned there that that cut in the mortgage reference rate, the 5-year loan prime rate of 25 basis points, while being greater than expected, was met with kind of, I don't know if it's a yawn or a little bit of disdain even in the markets. Is that fair?
Well, I have to say that it was not such a big surprise to the market because the PBOC had delivered some of the indication via some media before the reduction in the 5-year LPR. But actually, I have to say, people didn't expect that it was cut so much because we expected that it could be 5 or 10 bips, but it turned out to be 25. Well, I have some reasons for the 25 basis point cut. Although the policy rate, which is the 1-year MLF rate, was steady. Because in last year, August, when the PBOC cut the policy rate by 15 bips, the 5-year LPR remained steady. It didn't change. So that it allowed the 5-year LPR to have at least 15 basis points to cut in this year. So another reason, apparently the commercial banks add another 10 bips for the reduction. So that it totaled to be 25. So one thing we are thinking is that whether this can stimulate or raise China's housing market. That is the key question, because as we just decided, the 5-year LPR is the base or the benchmark for the mortgage rate. And apparently that it seems that the authorities are trying to help the housing market. But to be honest, we are not so optimistic on this because if you look at the housing market in China, it has been slipping over the past 2 years. And the sentiment in the market is very weak, especially in the lower tier cities, such as the tier 3 and tier 4 cities. So, and also we see the oversupply in the housing market. So that putting all this together, we think, yes, it will help, but the help should be very limited.
I'm wondering whether anyone is concerned about the pressure that this would put on banks. I mean, obviously, when you lower interest rates, it puts a little bit of pressure on your margins. Is that a chief concern, or will it be, let's call it a sacrifice that has to be made as authorities try to rescue or unwind this property crisis?
Well, I agree with you that the banks are not so happy with this. Actually, in January, I had a travel in Beijing and Shanghai and to see some bankers. And they told me that they were worried about the narrowing of their interest margin. But it seems that, as you said, it is more a political decision to press the interest margin further, because I think maybe the leaders think that the banking sector should do something to help the economy as a whole.
Yeah, it's about affordability, and even pressure is building here in Hong Kong for the government to relax some of the restrictions on buying homes that we've seen for almost a decade now, and we're even seeing that pressure coming from pro-China parties. And we're talking about things like the stamp duties, some of the friction that's in there. For instance, also the size of the down payment. In some cases, you have to put 50% down. Then you have to pay a 15% stamp duty, and it's on and on and on. Do you think that the time is ripe now for both Hong Kong and China to think about relaxing some of these restrictions?
Actually, I think it's not about the timing because for both especially for mainland China, they have been cutting the down payment ratio and also the mortgage rate and also relaxed the home purchase restrictions.
But you have to ask yourself, is it working?
Yeah, that is the question, whether it works. But honestly, it hasn't worked so much in China.
Do you think things are so desperate now that there's going to be a major initiative unveiled at the National People's Congress, which I guess is set for early March? Might authorities wait for that moment in time to unveil something that's a little bit more sweeping in scope? I mean, clearly there is just declining sentiment, not just as it relates to the property market, but the equity market as well.
Yes, I think for both the housing sector or housing market and the equity market, people have the same concern. It is whether China is still views the growth as the top priority. I think that would be a signal that we can see from the People's Congress in the coming months. But to be honest, I don't think that even the government or the authorities release the signal that we still view it very important. I really doubt how much the market can buy it.
I'm going to ask you a question. You're an economist, and you're going to say, oh boy, that's kind of a political question. But it seems like what we have here is an issue that comes down to societal considerations versus economic considerations. We understand that a lot of what President Xi Jinping is trying to do is good for the common man. But that may not be, in the shorter term, what's good for the economy. How do you decide?
Yeah, that is kind of, it could be a trade-off. Because if you want to make the common prosperity, or in other words, you want to help the common people.
Well, you want to make property more affordable to the average person, but then it slows down the economy to the point where the average person may not even have a job. What makes more sense?
That is the question, because I think what caused the pain, it was the timing. Because I think it was a bit late for the government to do so. They should have done that 10 years ago to do it. But if you leave the problem to today, you must have some price for that, right?
David, I'm wondering whether or not you could see a world where authorities, let's say at the central bank, begin to adopt something that both Japan and the U.S. have used, where the central bank has used its balance sheet through quantitative easing to address the problems that China is facing with so much bad credit right now. Is that something that you think they might experiment with?
Well, I have to say that I have been asked about this question at least a dozen of times over the past year. But I have to say that for China, the PBOC always have some quantitative tools. So when the PBOC is doing easing or tightening, it is doing so in both the price and the quantitative side. For example, the PBOC can raise or cut the RRR, which is definitely a quantitative tool. And also the PBOC can do something to inject more money via the MLF or the PSL. That two tools are also quantitative. So for the PBOC, it is not a question of whether quantitative easing or not. They always do that.
Yeah. All right, David. Thanks very much. I enjoyed this session quite a lot. David Chu, Bloomberg China economist. Joining us now is Shuli Ren, Bloomberg Opinion Columnist, to take a look at market sentiment on Chinese and Japanese markets. She wrote a piece citing two articles from Barron's, and one of them talked about how Toyota Motor Company was looking like a growth stock, whereas in China, it's a totally different story. Let's get to Shuli. Thanks very much, Shuli, for joining us here on the program. Is that still the case, even after the big run-up in Japanese shares? How long can this continue?
We don't know, but it does seem to be the case, especially early this year, January and February. Over the last decade, basically a lot of global investors have plowed their money into Chinese stocks, a lot of them trading in Hong Kong, right? And everyone knows that China's economy has some structural issues that cannot be solved within perhaps even a year or two. So that's why they're looking everywhere else. And India has become very expensive. So, of course, Japan is the other big liquid market that foreign investors can go to. That's why they're going.
When I'm listening to you, what comes to mind is the corporate reform that has taken place in Japan, which may be underpinning the rally that we have seen in Japanese equities. On the other hand, the situation in China where the regulatory regime is so mercurial and shifting, such a lack of clarity on what policy is going to be for the foreseeable future. Does that come into play in any way, do you think, that dichotomy?
Yes, absolutely. I mean, like in China, like I think investors at this point, they're not even looking for stimulus. They're just looking for some predictability and stability. I mean, with Japan, the corporate reform story is actually quite old. It started with Abenomics basically a decade ago. And I do want to say that Japan, the investment narratives that we are seeing on Japan, these are not new stories. They have been around for a decade. It's just that the investors being burned by China in such a dramatic fashion that they're willing to give Japan a second look. And it's not clear to me that Japan can finally come out of this deflationary environment.
I remember you from your days at Barron's. That was more than a decade ago.
Yes.
So this piece about Japan looking like a growth story and China looking like a value play. You say that it's a value trap, not a value play, particularly, I suppose, because of policy. Is it likely to change sometime soon? I mean, you are starting to see almost daily developments with the policymakers in China. Now, do they realize it?
I think there is some good trend. For instance, the new securities watchdog, he sounds a little bit more humble. He's willing to hear opinions from market participants, and that could be a good trend. But structurally, China's property sector used to account for 25% of the GDP. And structurally, this property sector has not found its bottom. I mean, let's just compare the home prices, right? From peak to trough to now, basically, home prices have come down only about 20%. During the U.S. subprime crisis in 2008, the price came down by 40%. So we just feel that there is not bottom yet. So regardless of how the Chinese government changes its tone, economy is economy, right? It's the fundamentals.
Yeah, the other thing that's interesting is after 30 years, we're getting an indication that Japan is leaving a deflationary trap, and it seems like China is now firmly, under one is firmly underway in China right now.
Yes, but I do want to say that it looks like Japan is coming out of the deflationary trap, but not quite, right? Like if this inflation is ongoing globally, I mean, it's unclear how much inflation Japan can have. And also global investors are now expecting Japan's economy to grow slowly, but not so fast that the Bank of Japan changes its quantitative easing. And that is a very blue sky scenario.
The policymakers in China are hinting that deflation has just about run its course. Do you believe them?
No, I mean, at this point, like China's statistics is all very opaque, right? Like we don't know what's in the CPI basket. But just from anecdotal experiences, everything is kind of on sale in China. Like if you go to restaurants, there are always discounts, deals, home prices, secondary home sales. There are always, some kind of under the table coupons and etc. So we don't believe that. No Chinese believes that.
So before you were at Barron's, you were here in the U.S. working for a major investment bank whose name I will not mention. So you have some familiarity with the banking industry overall, and I'm wondering, is there a way to compare and contrast what is likely to happen for Japanese banks versus Chinese banks, given the situation that you've been kind of laying out for us?
I think with Japanese banks, their biggest obstacle is, there has been no interest rate margin for Japanese banks because it's 0% for the longest time, right? So their problem is that some of them have gone overseas, like more brokerages as well, Nomura, etc. And then they could have exposure to the weakening global commercial real estate. With Chinese banks, their problem is that their interest rate margins are also compressing because the Chinese government wants the banks to give out loans very cheaply. But that really contracts the Chinese banks' profit margins, and that could hurt their capitalization ratios as well.
So if we look at China and try to figure out a way of getting out of this, you think that deflation is still pretty well entrenched and that households are, they're saving, they're not spending. Is there a way to transfer some of that wealth to households so that they can feel more comfortable? We often think of tax cuts. That's not often considered in China. What about some other measures that would move capital into the household sector?
I think at this point, it's the sentiments. And I'm not sure about this because China has no opinion polls. But I have a feeling that the households are just doing this revenge non-consumption because they were burned quite badly during the 3 years of COVID lockdowns, right? And just anecdotally, some people that I know who have no financial issues, they're still not willing to spend. They just think, why am I contributing to the economy? Like the government can take care of everything. Like it's almost kind of a revenge for the lockdowns. So if that is indeed the case, I mean, we have to talk about psychology instead of concrete measures.
Absolutely. That's a fascinating point. Shuli, thank you.
One of our big stories in the past 24 hours, Capital One Financial agreeing to buy Discover in a $35 billion all-stock deal. The deal would create the largest U.S. credit card company by loan volume. But there is a catch, and joining us now is Adam Haigh, Bloomberg Finance Editor, to discuss more on this story. I find this a fascinating story because it goes to a lot of things. Business model, it could help Capital One compete with Amex here and lower its cost by not having to process through MasterCard and Visa. Extra competition for MasterCard and Visa. You just go on and on. Of course, there's the antitrust concerns as well. Maybe we can deal with that first. Is this the type of story, Adam, that you think ultimately gets blocked by a Biden administration that is sort of anti-mega merger?
Yeah, well, the thing to watch, of course, is the timing of when any block would take place. Obviously, we're in an election year in the US, and there's a lot of political capital now going to go into scrutinizing this deal. And we've seen already Senator Elizabeth Warren, of course, come out quite quickly and make some quite clear comments on Twitter to raise the argument about how this not only threatens financial stability and reduces competition, she said, but raises costs for Americans is a typical kind of language that you would expect to get this into the political discourse, to try and examine some of the issues that we have. So the next few months will be crucial, but the timing, whether this ends up getting postponed and is a post-election decision or not, I think is crucial. There's obviously so many hurdles still to get through, so this could still drag on for quite some time.
I think the strategy is also interesting. If you're Capital One, and up until this point you've been catering to a lot of some subprime borrowers, this is an opportunity because Discover has traditionally kind of gone after those of kind of a higher credit quality. But one of the things that I think is equally as interesting here is that Discover has kind of put itself in a very weak situation. I mean, I think the stock has been decimated over a period of time. There were a lot of concerns here about management. And I'm wondering whether or not Capital One is basically capitalizing on another company's weakness.
Well, that could be a lot of truth in that, and obviously you see that often with M&A transactions where the company being acquired has been through quite some turmoil, and so the advertised kind of premium on this deal is about 30% of that closing price on February 16. But of course, you look at what's been happening to that stock, and it's pretty clear the position that they are in. So yes, I think there's a large degree of truth in that analysis that they are, Capital One is coming in at a time of real weakness for the company that they're buying. But of course, there may still be, a number of synergies, a number of kind of things that they can do to for a long-term shareholder for that still to be very, very rewarding.
Discover has struggled in trying to compete with Visa and MasterCard, let alone someone like American Express. So this would seem to be, almost a stroke of genius in the sense that the two together could be a formidable competitor to the other two. And I wonder whether that runs a little counter to the kind of knee-jerk reaction that we saw from Sherrod Brown and Elizabeth Warren. They couldn't possibly have had time to analyze the impact on the marketplace. You have a duopoly, a virtual duopoly now with MasterCard and Visa on the processing of this. Even Capital One has to run its processing through them. Like you said, maybe some time, maybe some cooler heads?
Well, indeed, and I think that goes to the heart of this. There's a lot of nuance in the analysis of the competition here. So there's a number of different things at play, and of course the distribution element for Discover is key. But how this addresses or changes the competitive landscape in the different sectors of the economy in which these companies operate, I think, is key. It's not kind of a one size fits all competition argument. There's lots of nuance and there's lots of kind of detail in there. And indeed, the quick response that we saw from some of these politicians speaks to that idea that you raised, that perhaps maybe we haven't gone through the detail. Let's just take a step back. Let's analyze really what this could do to the competitive landscape before reaching a conclusion whether this is anti-competitive or not.
I think that's very interesting also because Dick Durbin, I think, is trying to move forward legislation on the Senate side to foster competition among credit card networks, to Brian's point right now, right, that is pretty much controlled by Visa and MasterCard.
Yeah, that's a very good point.
Yeah, absolutely. Yeah, and these are long term. These are things that will have long term impact on this sector. So we shouldn't jump to quick conclusions. We should really look at the detail and examine just how this will impact the sector and how this will play out. Because ultimately, consumers need to feel that they would benefit from this long term. That they need that kind of sense of comfort for this deal to get done.
I guess the response in the marketplace, you have investors really running through the numbers, and it does inform a little. MasterCard down 3.5%, Visa down as well, Discover up. So obviously, it looks like it's almost like a knight in shining armor coming to the rescue. Discover gained 12.6%. And for Capital One, well, little changed. So what do you read into some of these stock price movements, Adam?
Well, I think some of those moves are bigger than others, right? So the Discovery 12, 13% or so move is pretty clear. We probably don't need to say that much about that. But some of the Visa one you mentioned, they're small moves really. They don't appear to me to suggest that this is an investor base that has decided that this is definitely a net negative for MasterCard in any meaningful way. So I think we should just pause for thought slightly and just understand what these stocks do over the coming days. I don't think it's all been decided in the most recent trade.
All right, Adam. Thanks so much. Adam Haigh, Bloomberg Finance Editor, with us live.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.